Hey guys, Dave here again. So in the previous video, we covered sources and uses of cash and what that means, right? So basically you calculate what is the amount of money or capital that's required upfront to start this business and how you're going to raise that capital, right? Through a combination of debt and equity. Now, I forgot to mention this in the last video, but remember the way I computed debt and equity, 1.5L and 4.38 was arbitrary. You can have any mix of debt and equity. I mean, you can't have any mix, but technically speaking, the numbers that I chose are arbitrary. So again, don't get anchored to these numbers. Just think of them as an input that you can play around with. So in this video, we are going to be building the balance sheet from scratch and incubating this company at t is equal to 0 or month 0, right? So before we do that, let's first ask ourselves, what is a balance sheet, right? So what a balance sheet does is it tells you what are the assets and the liabilities that a company owns at any given point of time on a particular date, like at one point in time. Assets could include items like cash, inventory, property, plant, and equipment, some of the other items, and basically tells you what you own at any given point in time. So assets will typically comprise of net working capital and fixed capital, like we discussed in sources and uses. Liabilities, on the other hand, tell you what you owe external parties, like debt, revolver debt, payables, and how much of the total assets of the company you own after accounting for what you owe, which is nothing but equity, right? So a very important thing to remember is that at any given point in time, your balance sheet must balance. So what does this mean, right? It basically means total assets have to be equal to total liabilities and equity, which basically means the sum of these four figures have to be equal to the sum of these 7, 8 figures, right? That being said, let's incorporate the balance sheet at t is equal to 0 or month 0 when we incubate this company. So let's go line by line on the asset side first. So money earmarked for salaries at incubation. So what is this, right? So remember, in the sources and uses tab, we assume we're going to require 2 employees. They're both going to get paid 10,000 rupees a month. And we were budgeting for 6 months of their salaries in case our business doesn't ramp up. So that will be this 1.2 lakh number. Now, again, remember, we have not paid these employees this 1.2 lakh in salaries. We're just keeping it in the bank. This is almost like a cash item, restricted cash item. We're keeping it in the bank just in case our business doesn't generate enough cash and we can't pay our employees. So this was money earmarked for salaries, same logic with money earmarked for transport. We're doing it for 180 days. Money earmarked for rent, which is over here. Same logic, money earmarked for utilities, which will be electricity plus water plus your gas cylinder, right? Now, inventory. What is this, right? This is nothing but the raw materials that you've purchased upfront. 1 month worth of raw materials. That would be this. PP&E, this is plant, property, and equipment. This is the fixed capital that is going to be used over and over and over again, and that's going to provide us benefits for more than just one use, right? So what's going to come over here? We're going to have rice cooker, we're going to have utensils, kitchen slab, jumbo burner, fridge. I think that about covers it. And upfront, we've not assumed that we're going to take any free cash, right? So cash is going to be 0. Sum of all these elements is going to be, should be equal to this. Wait, I missed an item. What is that? Transportation, employee, kitchen hardware, other kitchen and cabinet, sorry. So I think over here, forgot to include this item. Yep, 588,150, 588,150. So this is a sum of all of the fixed and working capital requirements that we're going to have when we start this company. So when we purchase this, right, like I was discussing in the previous video, we're going to have to finance this through debt and equity. So what was the debt amount? 4.38. What is the equity amount? 1.5. Now you might ask me, what are the other two items, right? Payables and revolver. So let's take them one by one. So payables is nothing but the credit that you have on your inventory from suppliers. So, which is the money that you owe to your suppliers for your raw materials. Now, when we start this business, we've assumed that we are going to fund all of our inventory requirements at the start for 1 month through debt and equity, simply because in reality, without an existing running business that generates cash flow, it could be very difficult to get a credit period from suppliers. Also, given the fact that these raw materials are perishable in nature, they're food items, right? So at T is equal to 0, we're not going to have any payable items. However, as we build this model and as Dev's Pulao as a company gets up and running, there is going to be a payables period, and we'll come to that in further videos. Second item, revolver debt, right? Like, what is revolver debt? So revolver is a form of short-term debt. Now, what purpose does it serve? So in the case that I start this business, I start Dev's Pulao, and the business burns cash in the first few months, I might need additional funding to cover that cash shortfall. Revolver is nothing but a facility to help provide me this. We will cover revolver in great depth in the debt schedule later on, but for now, just think of it as a short-term debt instrument to help you cover short-term cash flow issues if necessary. So at the start, it's going to be 0, right? Because these items are effectively like cash. What are the total sum of liabilities and equity? Same as assets. And remember, right, as I mentioned earlier, assets must always equal to liabilities and equity. This is very important. This check has to hold at every given point in time at the end of any given period. So now that we've incubated this company at T is equal to 0, we've incubated the balance sheet. In the next video, we're going to cover the P&L, and we're going to draw the P&L out completely, right from revenue right down to profit after tax. See you over there. Bye. Hey guys, Dave here. Welcome again. So in the previous video, we built the balance sheet from scratch at T is equal to 0, month 0. In this video, we are going to build the P&L or the profit and loss statement or the income statement from scratch. So before we begin, right, what is the P&L? It tells us how much revenue we generated, what costs did we incur, material costs, employee costs, other costs, and how much profit did we make during a certain period of time, like with between 1 month, the second month, the third month, a year. So in the case of Dev's Pulao, we will be building a monthly model from month 1 to month 12 for 1 year. As you can see, like I mentioned above, the items over here, you will cover them in greater depth. So let's start one by one, right? Let's first and foremost, I'm not going to start with revenue. You'll understand why in a bit. I'm going to start first with costs and then we'll go back to revenue. So let's start with material costs, right? How do you compute material costs? Number of plates sold into average COGS per plate. We have both these line items. Let's link them up. So month 1, let's go to the market sizing tab. How much do we? 1140. This is the volume in terms of number of plates of Dev's Pulao that we sold. And this is how it ramps up over the next 12 months. Average COGS per plate, we've got that in the unit economics tab. It's 120 rupees. And we're assuming over here that it will stay constant over the 12 months. Let's just lock the cell. F4 is the shortcut. Material costs are going to be this into this. That's the material cost in terms of what is the raw material cost of the products that we're going to be selling. We're going to be selling these many units in each of these months. In month 1, we're going to sell 1140 plates, and each plate's going to cost 120 bucks. So what is material margin? It's nothing but revenue minus material cost. Right now, revenue is 0. We'll come to that at the end of this video. You'll understand why I've done that. Material margin is material cost, revenue. Let's just put if error over here. Okay, now let's go to employee costs. So like we said, we have 2 employees, right? Each of them getting paid 10,000 bucks a month. So let's just compute it here. Employees is 2, cost per head is 10,000. Monthly employee cost is 20,000. Let's just link that to the model. Let's lock this F4. Let's assume that the employee cost over the period of the next 12 months stays constant at 20,000 rupees a month, 10,000 rupees a head. Dave Pinto's salary, assume I'm the entrepreneur, but I'm not going to take the salary. So let's assume this to be 0. Transportation costs. So we've assumed that daily transportation costs is 500 bucks. We have, let's just put it here, 500. How many days in a month? 20 or 30? 20, right? Because these are working days in terms of how many people are going to be present Monday to Friday. 5 fours are 20. That gives us roughly 10,000 bucks. Let's assume again that this cost is going to stay constant over the next 12 months. Utilities. So what utilities are we going to be using? We're going to be using electricity, water, and gas, right? So this is going to be a variable cost basis how many units of Pulao we make, right? So let's do it at the unit level. Electricity cost per month in the first month. How much was that? We budgeted 4,000 bucks. Number of units of Dave's Pulao produced in month 1 is 1140. So the electricity cost per unit in the first month comes up to roughly $4. Let's do the same thing for water and gas, right? So water cost, etc. Budgeted 100, number of units. Let's just copy it from here. Water cost per unit goes to almost close to nothing because we're using tap water, but nonetheless, let's do the same thing for gas. Gas unit. Unit 2000 and 140 divided by T is this. So this is giving me the unit cost to produce 1 unit of Dave's Pulao in the first month. So let's now go back to the model. Utilities cost will be nothing but number of plates sold into this lock the cell plus this lock the cell plus this. Yep. For rent, we've assumed monthly rent of 15,000. Let's assume this doesn't change again over the course of the next 12 months. This stays 15,000. So now let's compute EBITDA. It's nothing but material margin minus all of your other fixed and variable costs before interest, taxes, and depreciation and amortization. Again, don't worry that this is negative. This is negative because we haven't computed revenue yet. We'll come to revenue at the end of this module. Next, let's talk about DNA. So DNA stands for depreciation and amortization. Now, if you remember, right, we spoke about working capital and we spoke about fixed capital. Fixed capital will last for longer periods of time, more than a year. So from an accounting perspective, we are allowed to release those costs through the P&L over however long it is that you want to release them. So let's assume PP and E amortization period. Let's assume 24 months. Again, why 24 months? There's no logic. You can make it anything that you want, more than a year. So what is depreciation? It's literally allowing you to charge to spread this cost, the costs of your fridge, your rice cooker, your jumbo burner, etc., over a 24-month period. So this is going to be starting amount, fix the cell, divide by 24. That's correct. And remember, depreciation and amortization is not a cash charge. It's just credit that you are getting from the tax authority to release the cost of your fixed capital over a period of time. And we'll come back to this in the cash flow. After EBITDA, let's compute EBIT. So EBIT is nothing but EBITDA minus depreciation and amortization. Self-explanatory. Interest. So we're not going to compute interest right now. We're going to compute interest later on when we do the debt schedule, and you'll really understand why then. So leave interest for now. Profit before tax is nothing but EBIT minus interest, right? Tax, let's assume the company has a marginal tax rate of 25% as per cell AB23. So how do I compute tax, right? If my PBT is less than zero, I will pay zero tax. If it's positive, I will pay this into my tax rate. Right now, we're not paying tax because PBT is negative. PBT is negative because we haven't computed revenue yet. So we're coming to that in a bit. And PAT, of course, is profit after tax, total accrual profits that you make from operations in a given period of time. So that'll be this minus this, right? We've done everything except we've not computed interest expense yet. We've not computed revenue. Now look, in month one, you have so far 1.92 lakhs in loss because we haven't computed revenue. So how do I think about revenue, right? So I will have to have enough revenue to at least offset this loss, which means to break a profit, I'm going to have revenues of at least this amount of money, right? And this is before even computing interest costs. We know the number of plates that are going to get sold in a given month. I mean, we've already assumed that in the material cost. So this will be nothing but this. Now, even though we haven't computed interest exactly, we can get a ballpark figure of what interest is going to be in the first month. How are we going to do that? Let's just take the debt amount, which is 4.38, multiply that with the interest rate. And since this is on a monthly basis, let's just divide by 12. It's not the right number, but it's a right proxy to what the interest is going to be, right? Gives you 3,615 interest. Now, to break even at the profit and tax level, at the PAT level, you're going to have to generate revenue of at least 1.96 lakh. What does that impute in terms of pricing? 172. So if I put 172 over here, right, let's compute revenue A into P. So 172 is roughly the break-even pricing in month one. Now look, what I'm trying to illustrate over here is that pricing will, of course, be determined by the competitive landscape at the cafeteria and the demographics of the people over there. And given everything else, right? Typically, when you start a business, your costs are very, very real. Like when I start this business, I'm going to have these material costs, I'm going to have employee costs, transportation costs, utilities, rent. But the entire success of this business model is predicated on me realizing a certain level of pricing. Now, that again is not completely in my hands as an entrepreneur. It'll depend on the competitive landscape at the market. But say there's 170 to 250, right? Just for illustration's sake, I would make I would make profits on like an order of magnitude higher, right? Operating level. So that's a very, very important thing to keep in mind. We're going to come back to this at the end of the model once we complete everything and just illustrate how, in a case like this, if pricing really changes and we can get volumes at like a decent price, we can make a lot of money. Thanks. Hey guys, Dave here. So in the previous video, we covered the P&L, profit and loss statement. In this video, we're going to cover the balance sheet. So remember that we haven't computed interest expense yet. We're going to do that. Don't worry about it, but just keep track of it. I've highlighted this row in yellow. So let's look at the balance sheet, right? Let's start with the first line item, money earmarked for salaries at incubation. Now remember what this line item was. What was it, right? We have 2 employees. We're going to earn 10K a month in salaries. And we had kept money in the bank to pay these salaries for the next 6 months in case we were not able to generate cash from our operations to cover this cost. Luckily for us, operations ramped up and we sold 1,040 units of Pulao and we made money, right? But we didn't know that coming into the business. So how is this line item going to change? What is the salary bill for month 1? It's 20K, right? We're going to pay 2 employees 10K each, 10 to 20, 20K. How can we pay this cost item or any cost item for that matter? It can either come from revenue that you generate and the corresponding gross profit, or it can come from cash on your balance sheet that you have in hand to pay this. So let me give you an example of what I mean by this. Suppose you have been working, say, at a company for 1 year and you have 5 lakhs of savings in the bank and you earn 50K a month, say. And say the next month, you're going to hire a new cook to cook for you at home at a salary of 3,000 rupees a month. You can pay the cook salary, this 3,000 rupees a month, the next month when he or she joins, either through the 5 lakhs that you have in the bank or the 50,000 that you will be earning in your salary or your revenue, personal revenue in the next month. Now, in the case of Dave's Pulao, because we had earmarked this money in the bank at the start, as we were not sure how the business would ramp up, we can and we are going to pay these salaries from the money that was earmarked for this purpose until this account on the balance sheet goes to 0. So this 20K, right, in the first month is going to come from this 1.2 lakh balance. Now, when that happens, how will the 1.2 lakh balance change? It's going to go down by 20K, right? So let's just do that. This minus employee costs, right? So at the end of month 1, 20,000 bucks that was held as cash in the bank for this purpose has been used to cover employee costs. And my remaining balance at the end of the month for this account is 1 lakh rupees. Let me just put max 0. Why am I doing this? Because in month 6, this balance is going to go to 0, right? And if I don't do max, then the balance is going to be negative and balance sheet balances can't be negative, right? If I did this, you're going to have minus 20,000. So that's not possible. Hence, I'm putting max is at 0, right? Now, you could ask me, why am I accounting for this twice, right? So in the P&L statement, here we accounted for 20,000 rupees worth of employee expense. And over here, we are accounting for a release in cash amount of the same, right? So that's a very good question. I mean, cost should only be subtracted once, right? Not twice. You don't incur a cost twice. You're not going to pay your maid 3K from your bank and 3K from your salary. So that's a very good question. We will address this in detail in the cash flow statement. I get if this could be a little confusing right now, but bear with me and this will be clear once we cover the cash flow statement. Let's move to the next line item. Money earmarked for transport, same logic, nothing different. Let's just drag drop this down, make sure we have the right linking. Where is transport cost, 10K a month, right? Wait, shouldn't this go to zero in month 6? We budgeted for 180 days, right, of transportation costs. We did, but we also assumed that the number of days in which we're going to operate in a given month is going to be 20 and not 30, because offices are going to be open 5 days a week in that corporate building, and FIFOs are 20 and not 30. So we budgeted for 180 days, and hence 20 into 9 is 180. This balance is going to zero in month 9 and not month 6. Clear with me so far? Next, let's go to rent. Again, same logic, nothing fancy. Just link it to the right cell. I think, yep, balance goes to zero in month 6. Next, utilities. Let's link this properly. Okay. Wait, why is my utilities balance going to zero in month 5 and not month 6? Remember, utilities was a variable cost, right? Basis how many units of Pulao that I produce in a given month. Produce more Pulao, I will use more utilities. If I produce less Pulao, I will use less utilities. And hence, because our production ramps up, we're assuming that the amount that you had budgeted for 6 months upfront, and the 6-month unit being the unit of the first month, this balance is going to get exhausted before month 6. We're going to cover PP&E and cash later on once we complete the cash flow statement and the debt schedule. So leave that for now. So let's go to inventory, right? So what is inventory? It's the amount of raw material goods, work in progress goods, and finished goods that I'm holding at any given point in time. For the sake of Dave's Pulao, we've assumed that there is going to be no work in progress inventory and no finished good inventory, because we're assuming that everything that is produced on a given day is sold. So all of our inventory is going to be raw material inventory. So let's go ahead and make an inventory schedule. Let's go down here, key ratios. Let's call this balance sheet schedule. Type from month 0 to month 12. Let's put this over here. Okay. So what is the inventory schedule going to look like, right? What are going to be the line items? So you're going to have beginning inventory, correct? Then you're going to have purchases of raw material less material costs, which is your COGS, and then you're going to have ending inventory, right? So let's format this. Okay. So what was the ending inventory in month 0, right? Was what you capitalized in the balance sheet, which was this balance. What was this balance? Nothing but the amount of raw materials you bought with 1 month's notice. Now, how does the schedule work? So let's take it line by line. So the beginning inventory at the start of month 1 is going to be same as the ending balance of the previous month, just like a follow through, right? Remember, all of this inventory that we budgeted was for 1 month, the first month. In that month, how much did we sell? worth of goods. We sold, I think, 1140 units. And what was the material cost? Let's go to the P&L and find out. 136800, or same as the starting inventory. And what is purchases of raw materials, right? So in this month, I started with this much of inventory. I sold this much of inventory, but my business is not going to stop at the end of month one, right? It's going to continue to month 2, to month 3, to month 4, month 5, month 6. And hence I'm going to, once this inventory gets over, I'm going to have to replenish this inventory. So this purchases of raw materials just represents me replenishing that inventory. So how do I think about this line item, right? So in a given month, say during month 1 at the start, I don't know how much I'm going to be able to sell in month 2, or even say at the end of month 1, right? I don't know whether I'm going to sell X unit, 1,400 units, 1,600 units. I will have some sort of schedule in terms of how I think about it. But let's just say, for the sake of argument, that let's just first and foremost, let's just put down the number of units of Dave's Pulao sold, right? So do we have that? 140, right? So, okay. When I am in month 1, at the end of month 1, and I've sold 1140 units of Dave's Pulao, I will have some sort of estimate for how much I'm going to sell next month, but I don't know what that number is exactly, right? I don't know that I'm going to be able to sell 1420 units of Dave's Pulao. Say I will have a budget that should be around this number. Let's just say I expect, just for the sake of argument, let's say I expect to sell 1420 units of Dave's Pulao next month, but that of course could vary, right? So I will have to budget at the end of month 1 how many units I'm going to be able to sell at the end of month 2, and basis that I'm going to have to purchase materials basis that budgeting. So let's just call this inventory budgeting, right? In terms of number of units, let's make it like a percentage. So what this number tells you is, at this month, at the end of this month, I think I might sell 1420 units of Pulao, but to be safe, let's just buy slightly more inventory in case we sell more. It could be slightly less as well, but in this case, let's just assume we're going to take this at a factor of 105%. Now, let me explain to you what this 105% is, right? So let's come up with another item called number of units budgeted for inventory at the end of month 1. When I've sold all of this inventory, I need to buy new inventory. And I believe that I will be able to sell up and around 1420 units of Dave's Pulao. I don't know what the exact figure is. I think it will be close to this, but I think it could have like a 5% upside increase. So I'm budgeting for that over here, it's 105. So the number of units at the end of month 0 that I think I'm going to buy to be able to produce units next month is going to be this into this, right? Why not this into this? Because this has already been sold. This is what I expect to sell in the next month. I'm going to slightly buy more inventory in case we sell more. So let's do this. Let's do it here. Has a boundary condition because we have done this model till month 12. Let's just assume in the final month, I mean, your demand kind of stabilized. Let's just say, let's highlight this in yellow. This is just A into B. So now at the end of month 1, I'm going to buy raw materials for 1491 units of Dave's Pulao. In terms of, if I can produce 149 units of Dave's Pulao, I might end up selling 1420, which I do eventually end up selling, but I'm just going to budget extra. So what are my purchases going to be? It's going to be number of units budgeted for inventory into the average COGS per plate, the average material cost per plate, right? Which is, we got this. So then my ending inventory balance is nothing but the sum of this. Why? Because you had certain inventory, you sold certain goods, the balance went down, and to replenish that inventory, I bought some more goods. Hence, this is my net balance. Now let's just pull this through and through. Now we have inventory as a line item. Let's link it back. So we've linked inventory. So on the asset side, we're going to cover these two line items later. Let's just sum, or let's just copy paste this formula. Here. So now we've completed the asset side, right? So on the liabilities and equity side, let's cover revolver, debt, equity later on in the debt schedule and the cash flow statement, because these are more financing items and we can't really model them at this juncture, but don't worry about them. We'll come back to them. Let's go to payables. So what is payables, right? When you bought these raw materials, when you made these purchases, you purchase this inventory from your supplier, some supplier, right? So how much did you purchase? You purchased for roughly 1 month worth of inventory. Why? Because the raw materials are perishable, they're going to get spoiled. And you thought in the next month you'll sell 1420 units of Dave's Pulao, you budgeted for 1491. Now, what is payables? It's the credit that your suppliers of these raw materials will give you in terms of, hey, they gave you the goods today, but you don't have to pay them today, right? You can take the goods from them today, you can convert them to raw materials, you can sell them, realized revenue, make money, and pay them at the end of 1 month, 2 months, 3 months, whatever. So let's just come up with a mathematical way of thinking about payables, right? So let's say the days of payables on material costs is 30. What do I mean by 30? At the start of month one, your supplier gives you 1.78 lakhs worth of inventory, but he doesn't take the money from you upfront. You can pay him back in 30 days. That's what the 30 over here signifies. Let's just take this here. So once we have this 30, right? How do we model payables? How do you think about this? It would be the purchases that you made from this supplier into days of payables divided by what? Would it be 30, 60, 90? What would it be? This material is for 1 month, right? So it'll be for 30, 1 month worth of sales. So your payables is going to be this balance. Let's just link that up over here. Link that. Let's just sum up the liabilities and equity piece. Got that. And now let's see if assets is equal to liabilities plus equity. It's not, right? So are we in trouble? We're not in trouble. We haven't filled the entire balance sheet, and we're going to do that once we cover the cash flow statement and the debt schedule. So don't worry about it. But we're definitely going to come back to this and link in everything that's missing, everything that's been highlighted in yellow. So thanks, guys. We're going to cover the cash flow statement in the next video. See you guys there.
Hey, thanks a lot for watching the video. Hope you found it useful and also got a few actionable insights.
Check out our website and join the mailing list for regular content. Do spread the word and share it with anyone else you think might find this useful.